Most traders believe the path to consistent profits is adding more setups to their arsenal. More patterns, more opportunities, more ways to catch moves in the market. It's logical, right? But here's what nobody tells you. Every time you add a new setup, you're resetting yourself back to beginner level. Ed Sikota turned $5,000 into $15 million trading exactly one setup. Paul Tudor Jones called the 1987 crash using one core pattern. Mark Minervini won multiple U.S. investing championships focusing on one specific setup. Meanwhile, the average retail trader churns through 7 different patterns in a single week and wonders why they're still losing money. The uncomfortable truth is this: more setups don't create more opportunity, they create more chaos. You're spreading your pattern recognition so thin that you never develop the unconscious competence that separates professionals from permanent beginners. By the end of this video, you'll understand exactly why every legendary trader in history obsessed over 1 or 2 patterns, and why your inability to do the same is the single biggest thing destroying your edge. This isn't about motivation. It's about the brutal math of pattern recognition and why mastery at one thing will always beat familiarity with everything. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Let's start with something that sounds completely counterintuitive. That breakout setup you've been trading for the past 6 months, you're finally getting good at it. You're starting to notice the subtle texture differences between the setups that rip and the ones that fail immediately. You can feel when the volume signature is right, when the consolidation pattern has that tight, coiled energy that precedes real follow-through. Then you discover order blocks. The concept makes perfect sense. Institutional imbalances, smart money footprints, areas where price should react. You add it to your strategy. And in that exact moment, you become a beginner again. 0 repetitions with this new pattern. 0 unconscious recognition. 0 edge. You think you just doubled your opportunity set. What actually happened is you cut your expertise in half. This is the beginner's reset trap, and it's destroying more accounts than blown risk management ever could. Every new setup you add doesn't expand your capabilities. It fragments them. You had one pattern you were approaching mastery on. You were building a database of subtle variations, learning which market conditions made it work and which made it fail. Now you're splitting your screen time, your mental bandwidth, your pattern recognition development across 2 completely different frameworks. The trader who's seen a bull flag 200 times isn't thinking anymore. They're recognizing. They know instantly if the consolidation is too loose, if the volume is dying incorrectly, if the broader market context is wrong. That's not analysis. That's pattern memory built through obsessive repetition. But when you're trading 10 different setups, you're seeing each one maybe 20 times. 20 repetitions isn't mastery. 20 repetitions is barely past the tutorial phase. Here's what this looks like in real time. It's 10:47 in the morning. A stock on your watch list just broke above resistance on expanding volume. Your breakout setup is flashing green. But wait. There's also bearish divergence building on the RSI. That's your reversal signal. And it just touched the 21-day moving average. That's your moving average rejection play. 3 different setups, 3 different directional biases, 3 different trade plans. Which one do you take? You spend 3 minutes analyzing. By the time you make a decision, the breakout has already moved 4%, and you're either chasing or watching from the sidelines. Or worse, you take the reversal setup because the divergence looks cleaner, and you get immediately stopped out as the breakout continues exactly as the first signal suggested. This isn't trading, this is paralysis with a brokerage account. Compare that to the trader who only trades breakouts. The same setup appears on their screen. They don't debate. They don't analyze three competing frameworks. They see their pattern. They recognize the characteristics they've seen 100 times before, and they execute in under 30 seconds. No internal conflict, no second guessing, no wondering if they should wait for more confirmation. They've traded this exact scenario so many times that execution is mechanical. That's the difference between conscious analysis and unconscious competence. When you're still asking yourself, is this really the setup? You've already lost. The edge belongs to the trader who knows, not the trader who thinks. Chess grandmasters can glance at a board for 5 seconds and recreate the entire position from memory. But show them random pieces in random positions, and they perform no better than beginners. They haven't memorized individual pieces. They've memorized patterns from seeing thousands of real games. That's the difference between memorization and recognition. Your trading works identically. After you've seen a specific setup 200 times, you stop analyzing it piece by piece. You recognize it as a complete pattern. You know if it's clean or corrupted. You know if the context is right or wrong. You know which variations tend to work and which tend to fail. That recognition only comes from depth, not breadth. Take ICT traders who focus exclusively on order blocks. An order block is simply a decision point where institutional money has entered aggressively, leaving an imbalance that price tends to revisit. Simple concept. But the ICT trader who's traded nothing but order blocks for 2 years sees things you don't. They recognize immediately when an order block is likely to hold versus when it's going to get swept through. They can tell from candle structure alone whether smart money is still interested in that level or if it's been abandoned. They know that the first retest of an order block has the highest probability, second retests work sometimes, and third retests almost never hold. They know that order blocks below a liquidity sweep have significantly higher win rates because smart money just trapped retail traders. None of this is in the free YouTube videos. This is knowledge built from repetition, from seeing the same pattern in 100 different market conditions across different volatility regimes and sector rotations. And if you're finding value in this breakdown of how real edge actually develops, do me a favor and subscribe to the channel. We don't do hype here at Trader's Bible. Just the uncomfortable truths about what actually separates profitable traders from everyone else. Hit that notification bell so you don't miss the next one. Now here's where it gets even more brutal. You're not just resetting your skill level when you add new setups. You're creating something worse, internal warfare. Every chart becomes a debate between competing frameworks. Your breakout system says buy. Your mean reversion system says wait for the pullback. Your momentum system says it's already overextended. You're not trading the market anymore. You're trading an internal argument about which strategy to trust. And that internal conflict destroys something critical: consistent execution. When you're trading multiple setups, you can't build execution consistency because every trade feels fundamentally different. Your last trade was a bull flag breakout. It worked.
Made 2R. Your current trade is an order block retest. Completely different entry logic, different stop placement, different profit target, different holding pattern. What happens? That bull flag gave you confidence. This order block setup? You're not as sure. You've only traded it 30 times, so you take half size. You move your stop tighter because you're nervous.
You exit early because it's not moving as fast as that bull flag did. Result? You cut a winner early, made 1R instead of 2, and you just reinforced the belief that order blocks don't work as well as breakouts. But the truth is, you sabotaged the trade with inconsistent execution born from insufficient repetition. Now that order block setup stops you out. Small loss, no big deal, right? Wrong. You're emotionally compromised, you're frustrated, and your next opportunity is a Fibonacci retracement setup. But you're not in the right mental state anymore. You're either going to skip it entirely because you're gun-shy, or you're going to overtrade to make back that loss. Either way, you're not executing your strategy. You're executing your emotions. This is the hidden cost of trading multiple setups that nobody talks about. You can never build the emotional discipline that comes from repetition. Every trade feels like a new test. Every loss feels personal instead of statistical. Compare that to the trader who only trades one setup. Every trade feels the same. Same entry criteria, same stop logic, same profit target, same market context. After 100 repetitions, execution becomes completely mechanical. They're not emotionally invested in each individual trade because they've seen this trade 99 times before. They know some win, some lose. It's just statistics now. They take full position size every time because they trust the setup. They hold for their full target because they know the pattern. They take their stop when it hits because they've learned that fighting this particular setup never works. That's consistent execution. And consistent execution is what separates profitable traders from everyone else. Ed Sikota turned $5,000 into $15 million trading one thing: trend following breakouts. People would show him other opportunities constantly. Ed, this stock is oversold, huge bounce coming. He'd ignore it, not his setup. Ed, perfect mean reversion play here, easy money. He'd ignore it, not his setup. He watched thousands of potential trades pass by because they weren't his pattern. And that discipline, that consistent focus on one setup, is exactly why he compounded at rates that seem impossible. But here's what most traders miss entirely. Your edge isn't some universal law that works everywhere all the time. It's a fragile, statistical advantage that only exists under very specific conditions. That bull flag breakout that's printing money during a strong uptrend with expanding volatility, it becomes a systematic death trap the moment the market shifts into choppy range-bound consolidation. Same exact pattern on your chart, same entry rules, same stop placement. Completely different outcome because the regime changed and your edge evaporated with it. This is what destroys accounts. Not bad setups, but good setups traded in the wrong conditions. And you only learn to feel those conditions by obsessively watching one pattern across hundreds of different market environments. Paul Tudor Jones understood this better than almost anyone. His trend exhaustion setups worked because he knew exactly what market regime he was trading in. When markets were trending hard in one direction and showing exhaustion signals, his edge activated. Try to trade those same reversal patterns during a grinding, directionless market. They fail constantly.
Jones didn't take those trades. He waited for his regime. When it showed up, he attacked with size. When it didn't, he did nothing, sometimes for weeks. Most traders don't do this. They see their pattern and take the trade regardless of whether the market is trending, ranging, whipsawing, or stuck in no man's land. Then they wonder why the same setup that worked perfectly last week is suddenly losing money this week. The setup didn't change. The regime did. Ed Sikota made his fortune because he understood his edge only existed in high volatility trending environments. When volatility dried up and markets went sideways, he stopped trading. He didn't force trades.
He didn't try to adapt his trend-following system to low volatility conditions. He just waited, sometimes for months, because he knew his edge didn't exist in that environment. Here's the brutal truth that nobody wants to hear. Your edge is conditional. It's not always there. Most of the time, it's not there. And when you're trading 10 different setups, you can't possibly track the regime and volatility conditions for all of them. You're taking breakout trades in range-bound markets. You're taking mean reversion trades when volatility is spiking. You're fighting the regime because you don't even know what regime you're in. The trader focused on one setup doesn't have that problem. They know exactly when their edge exists and when it doesn't. They can feel when the regime is shifting. They can see when volatility is about to collapse. And they stop trading before they give back their gains. They're not just pattern recognition experts. They're context experts. And context is what separates a setup with an edge from a setup that's just a coin flip. William O'Neill didn't just trade cup and handle bases. He traded cup and handle bases on leading stocks, in leading sectors, during confirmed market uptrends with healthy volatility. Remove the uptrend. He didn't trade. Remove the volatility. He didn't trade. Remove the sector strength. He didn't trade. He knew his edge only existed when all those conditions aligned. So he waited, sometimes for weeks, sometimes for months. When those conditions appeared, he traded aggressively with size and conviction. When they didn't, he preserved capital. And here's the paradox that kills most trading accounts. More setups feel like more opportunity, but they actually create less. When you're trading one setup, you develop a sixth sense for when market conditions favor your edge. You learn to sit still when conditions are poor. You learn to attack when conditions are optimal. When you're trading 10 setups, you always have a reason to trade. Market choppy? Perfect for range trading. Market trending? Perfect for breakouts. Low volume? Perfect for mean reversion. High volume? Perfect for momentum. You've built a system that justifies trading in every condition. You're always in a trade because there's always something flashing on your screen. And that's the problem. The best traders in the world spend most of their time doing absolutely nothing. Jesse Livermore, Ed Sikota, Paul Tudor Jones. They waited for their specific setup under their specific conditions. When those conditions aligned, they attacked with size. When they didn't align, they sat on their hands. You can't do that when you're trading 10 setups. There's always something that looks like a setup. Always a reason to click buy. You think you're increasing opportunity. You're actually increasing noise. Mark Minervini trades one thing: late-stage bases on leading stocks with strong relative strength. He skips thousands of stocks every week because they don't fit his criteria. He misses lots of trades on purpose because he's not trying to catch every move in the market. He's trying to catch the specific moves where he has an edge That discipline, that ability to say no to everything except your one setup, is what separates winners from everyone else.
So here's what we need to talk about next. If focus on one setup is the key, how do you actually choose which one? Because picking the wrong pattern to master is just as deadly as spreading yourself across 10 of them. The criteria for selecting your one setup isn't what most traders think. The criteria for selecting your one setup isn't what most traders think. Most traders pick a setup because it looks cool on YouTube, or because some guru said it has a 70% win rate, or because it worked once and they think they've discovered the Holy Grail. That's not how you choose the pattern you're going to spend the next 2 years mastering. You need 3 specific filters, and if your setup doesn't pass all 3, you're wasting your time before you even start. First filter, personal resonance. This sounds soft,
But it's actually the hardest requirement. You need to pick a setup that matches your natural psychological wiring. If you're an impatient person who gets antsy sitting in trades, don't pick a trend-following system that requires you to hold positions for weeks through massive drawdowns. You'll sabotage yourself every time. If you're risk-averse and uncomfortable with volatility, don't pick breakout trading where you're entering at the most volatile moment with the widest stops. Your personality will override your strategy every single time. Mark Minervini can hold momentum stocks through violent pullbacks because his personality is wired for aggressive growth. That's not a skill he learned. That's who he is. Ed Sikota could sit through months of doing nothing waiting for trends because patience is embedded in his psychology.
if you're not naturally patient, you will not successfully trade a trend-following system, no matter how good the strategy is. Here's how you figure this out. Look at your last 50 trades, not the ones you planned to take, the ones you actually took. What were you most comfortable executing? Were you more comfortable entering on breakouts or pullbacks? Were you more comfortable in fast-moving momentum environments or slower grinding trends? Were you more comfortable with tight stops or wider stops? Your comfort zone isn't a weakness to overcome. It's a signal about which setup will align with your natural decision-making. The trader who fights their personality loses. The trader who builds a strategy around their personality wins. Second filter, frequency. Your setup needs to appear often enough that you can actually accumulate the repetitions required for mastery, but not so often that you're overtrading. If your setup only appears once a month, you're not getting enough reps. It'll take you years to reach even basic competence. If your setup appears 50 times a day, you're probably looking at noise, not signal, and you'll burn out trying to monitor that many opportunities. The sweet spot is somewhere between 2 and 10 quality setups per week. That's roughly 100 to 500 setups per year, depending on how actively you trade. After 2 years, you're approaching the 200 to 1,000 repetition range, where true pattern recognition starts to develop. Ed Sikota's trend-following breakouts didn't appear every day. But they appeared often enough during the right market regimes that he could build a massive database of pattern recognition. Paul Tudor Jones's trend exhaustion setups were rare, but not so rare that he couldn't develop deep expertise over his career. Here's the test. Pull up your charts. Look at the last 6 months of data. How many times did your potential setup appear? If it's fewer than 50 times, it's too rare. If it's more than 300 times, it's probably too common, and you're looking at a lower quality signal. Somewhere between 50 and 200 appearances in 6 months is the range where you can build real expertise without overtrading or waiting forever between opportunities. Third filter, mechanical clarity. This is where most traders fail the test completely. Your setup needs to have objective, non-negotiable entry and exit rules. If you can't explain your setup to someone in under 2 minutes with zero ambiguity, it's not a real setup. It's a collection of subjective feelings dressed up as a strategy. I enter when price breaks out with volume is not a setup. How much volume? Relative to what? What defines a breakout? Where's the exact entry price? Where's the stop? Where's the target? If any of those questions require you to say, well, it depends, you don't have a mechanical setup. You have a vague concept. And vague concepts don't build pattern recognition because every instance looks different depending on your mood that day. William O'Neill's cup and handle setup had mechanical clarity. The cup needed to be between 7 and 65 weeks long. The handle needed to form in the upper half of the cup.
The breakout needed to occur on volume at least 50% above average. The buy point was 1 tick above the handle's high. The stop was below the handle's low. Zero ambiguity. That's why thousands of traders could learn his system and actually execute it consistently. Compare that to the trader who says they trade order blocks when smart money shows interest. What defines interest? How do you measure it? What's the exact entry trigger? If you can't answer those questions with numbers and specific candle patterns, you're trading a feeling, not a strategy. Here's how you test for mechanical clarity. Write down your setup rules. Give them to someone who's never seen a chart before. If they can't execute your strategy exactly as you would based solely on your written rules, your setup isn't mechanical. You need to tighten it until there's zero interpretation required. This is uncomfortable because it forces you to confront how much of your strategy is actually just discretionary guessing. But that discomfort is exactly why most traders never develop real expertise. They're trading 10 different vague concepts instead of one mechanical system. Now here's what happens once you've selected your setup using these 3 filters. You need to commit to the stupidly simple process that separates amateurs from professionals, the 100-trade audit. This is non-negotiable. You cannot know if your setup actually has an edge until you've traded it at least 100 times and analyzed the results. Not backtested, traded, with real money, or in a simulator that forces you to make real-time decisions.
Backtesting will lie to you because you'll unconsciously cherry-pick the best examples and ignore the messy, ambiguous setups that appear in real time. You need to feel the discomfort of pulling the trigger when you're not sure. You need to experience the emotional roller coaster of wins and losses. You need to see how the setup behaves in different market conditions when you don't have the luxury of hindsight. Here's the structure of the 100-trade audit. You're going to track 7 specific data points for every single trade. Entry price, stop price, target price, market regime when you entered, volatility condition when you entered, outcome, and your emotional state during execution. That last one sounds soft, but it's actually the most important. Were you confident or hesitant? Did you take full size or scale down? Did you exit early or hold for your target? Did you move your stop or leave it alone? Your emotional patterns will reveal where your setup actually breaks down, which is almost never where you think it breaks down. After 100 trades, you're going to analyze the data for patterns. What was your win rate? More importantly, what was your win rate in different market regimes? Did your setup work better in trending markets or choppy markets? Did it work better during high volatility or low volatility? Did it work better in the first hour of trading or the last hour? Did you execute it consistently? Or did you self-sabotage certain variations? This is where your edge reveals itself. Not in the overall win rate, but in the specific conditions where your win rate jumps from 50% to 70%. That's your zone.
That's where you focus all your future effort. Paul Tudor Jones didn't just trade trend exhaustion. He traded trend exhaustion during specific volatility spikes in specific market regimes. That specificity is what created his edge. Ed Sikota didn't just trade breakouts. He traded breakouts in trending markets with expanding volatility. When those conditions disappeared, so did his edge, and he stopped trading. The 100-trade audit is how you discover your version of that specificity. It's how you move from I trade breakouts to I trade breakouts in the first 90 minutes of trading, when the market is in a confirmed uptrend and volatility is above its 20-day average. That level of specificity is what transforms a coin flip into an edge. And here's what nobody tells you about this process. The first 100 trades will be painful. Your win rate will probably be around 50% or worse because you're still learning the subtle variations. You'll miss obvious winners. You'll take obvious losers. You'll execute poorly and sabotage good setups. That's not failure, that's data collection. You're not trying to make money during the 100-trade audit. You're trying to build a database of pattern recognition. The money comes later, after you've identified your specific edge within the setup. If you're trying to be profitable during the learning phase, you'll quit before you reach competence because the early results will be discouraging. Mark Minervini didn't become a champion trader in his first 100 trades. He spent years losing money and refining his specific variation of momentum trading until he found the exact conditions where his edge existed. Then he went all in on that specific pattern. That's the path. Struggle, refine, identify, master, execute. Most traders quit during the struggle phase because they think struggle means the setup doesn't work. Struggle means you're still learning. It's supposed to be hard at first, but here's the part that breaks most traders, even after they've selected their setup and started the 100-trade audit. They lose discipline and add a second setup before they've mastered the first. They hit trade 73, they've had a string of losses, they're frustrated, and suddenly that mean reversion setup starts looking really attractive. Maybe I'll just add this one thing to catch the moves my breakout system misses. And just like that, they reset back to beginner level. All that progress gone. You're now a beginner in two things instead of approaching competence in one. The trader who makes it through to mastery is the trader who has the discipline to say no to every other opportunity until they've hit at least 200 reps on their primary setup. So here's what separates the traders who actually make it from the ones who stay stuck forever. It's not intelligence, it's not capital, it's not access to better tools or information. It's the ability to resist the temptation of more. More setups, more strategies, more complexity. The successful trader picks one thing, commits completely, suffers through the learning curve, identifies their specific edge,
and then executes that one thing relentlessly while ignoring everything else. You came into this video thinking the answer was adding more setups to your toolkit, more patterns, more opportunities, more ways to catch moves in the market. That's what every trading course and YouTube channel tells you. But now you understand why that approach keeps you permanently stuck at beginner level. More setups don't create more opportunity. They fragment your pattern recognition and destroy the one edge you are actually building. We covered why every new setup resets you back to zero, forcing you to split your repetitions across multiple patterns instead of going deep on one. We talked about how unconscious competence only develops after hundreds of reps with the same setup, and how spreading yourself thin keeps you trapped in conscious analysis forever. We broke down why multiple setups create internal conflict and decision paralysis, making every chart a debate instead of a clear execution. We explored how edges are fragile and conditional, only existing under specific market regimes that you can only learn to feel by obsessively watching one pattern across hundreds of different conditions. And we revealed the paradox that increasing your setups actually decreases real opportunity, because you lose the ability to sit still and wait for the specific conditions where you have an unfair advantage. Ed Sikota, Paul Tudor Jones, Mark Minervini, William O'Neill. They didn't win because they knew more setups than everyone else. They won because they knew one setup better than anyone else. That's the path.
Pick your pattern, commit to depth, not breadth, trade it 200 times, build your database, identify your edge, execute relentlessly. Everything else is just noise that keeps you from ever reaching mastery. The market doesn't reward the trader who knows 20 setups. It rewards the trader who executes one setup better than everyone else executing it. That's the difference between staying stuck and actually making it.